And we are red, reacting to that news of the morning on the PPI. Hotter, the largest monthly increase in some 3 years. It throws a bit of a wrench into the no inflation narrative, if anything. The question really for all of you, I think for us here on the desk, is does it wreck the September rate cut narrative? If anything, it kills the 50 idea probably, but what about the whole thing?
I think it takes 50 off the table, and I think the market effect of that is the optimism that everyone had yesterday. We began the show citing the recovery that you were seeing in biotech and small caps and home builders, so that's being priced out today. You're seeing, once again, the Mag 7, the large caps name, leading the market higher. I still think you're going to get your 25 basis point rate cut in September. I also think that potentially is all you might get in 2025. December might be taken off the table. So the opportunity for us to come on the air over the next several months and say, okay, well, the market is, broadening out. We're getting the dispersion effect. That, to me, is a little tentative right now.
Shanna, Joe paints the picture of a hawkish cut, right? Leisman declares today that the conversation has changed. And it's not about 50 or 25, it's 25 or nothing. And if you listen to some of the Fed speakers, another one, Musalem from St. Louis, came on the network this morning with him and said he's still open-minded. There are risks on both sides. So it remains to be seen. But I think Joe rightly points out what's happening in the market today and where it's most acute. If you throw up, for example, the XHB, if you throw up, so the Russell's up 5% this week. Why? Rate cuts. XHB, the home builders are up almost 5% this week heading into today. Why? Rate cuts. And now maybe the sizzle is taken off that trade?
Well, I think, as you know, we've talked about this before. We have been fairly constructive on small caps, and we felt like lower interest rates were just one of the many catalysts that could potentially propel small and mid cap stocks to perform better in 2025. And I think the challenge here, Scott, is that, if you're looking for those catalysts in terms of this deregulatory impulse, lower taxes, some of this accelerated depreciation that we see coming out of the one big beautiful bill, you also have in your mind that some of that investment is probably predicated on a more accommodative rate environment, because they're still going to need to be borrowing, particularly for smaller businesses, in order to make those investments. And so I think the challenge here is that it's not just higher PPI, Scott, it's higher services costs within that PPI. That's really kind of put a little bit of fear in terms of the market as to how much we get in terms of lower rates. And so I think if you're looking at the small cap trade in particular, for those of you who are invested in it, a lot of cyclical names in there. But again, looking at the underlying momentum we've had over the last couple of weeks, it has been very inextricably tied to this rate cut.
Well, I don't think
scenario.
I'll take issue, I guess, with your using the many catalysts around small caps, because there really haven't been any catalysts other than the idea of rate cuts. It's the only thing that has gotten the small cap trade to work lately, and it's quite obvious if you're going to take a jumbo off the table and you're going to debate 25 or nothing, that there's going to be a fairly sizable pause in the idea that those stocks can work, no?
And I take issue with your questioning the transmission potentially of things coming out of the one big beautiful bill, and the fact that from a valuation perspective, continue to be much more attractive than the large, the mega cap end.
Well, to the believers in that trade, they're cheaper for a reason. Their valuations are lower for a reason. The small cap trade didn't get totally ignited when the big beautiful bill, as you say, was passed. If the market believed that that was a catalyst for that trade, it would have already started working. It didn't do anything until we got the idea of a bad jobs report, the tremendous revisions that we had, and then the belief that you're going to cut. That's the only thing that started this trade. Admittedly,
there's some additional overhangs in that universe, Scott, that I don't disagree with you on. You talked about healthcare, biotech in particular. You mentioned the fact that home builders are a big part of. Those are two areas where there admittedly has not been strong or even relatively strong investor sentiment over the last couple of months.
Right, because rates have been too high.
But there comes a point when those trades are going to become more attractive. We're going to get more clarity on healthcare policy. And Scott, eventually there is going to be an understanding, acceptance, and digestion of where rates are going to be, and that is going to ignite a second, a wave of additional home prices.
You need the earnings growth. Small caps don't have the earnings growth that mid and large caps do. That's the challenge.
So, Kev, Wells Fargo today, their investment institute downgrades small caps to unfavorable. They look at the rally. It's taken the Russell, they say, to levels where the slowing economy and still high borrowing costs put risk versus potential reward out of balance. You agree with that? I mean, if you look at what's up this week, Russell's up 5, home builders up 4.5, biotech up 4, retail up 3, and healthcare in general is up 2%. Are many of these trades now put on hold after today's print?
I think they have to be. I mean, there was tremendous enthusiasm for breadth of the market. We run a diversified portfolio, so we like seeing healthcare up, we like seeing retail up, we like seeing home builders up, although we own Home Depot and not a traditional home builder. And I think the PPI number today, to Joe's point, really puts that a little bit on the back burner. So I see no reason to own small caps ever, but I say that as a large cap manager, so please take it with a grain of salt.
But what about, Bryn, the broadening idea in general? I don't know if the market got well over its skis on the idea that 50 was going to be legit, despite the Treasury Secretary saying it a couple times on television this week. Despite maybe others speculating that, okay, maybe they actually will do a jumbo cut. That seems to be a narrative that's going to be buried for the time being. Is the broadening trade also?
I think that was just a narrative. I don't think there was a 50 basis point rate cut at this point would signal something's wrong. And so I think where in the 70s and 80s, the Fed had this stop-start mentality of raising and lowering rates. The Federal Reserve today wants to start cutting and be cutting consistently, not doing this 1970, 1980s type of rate cut, rate hike, rate cut, rate hike. And so I think that by the end of the year, we will have 1 or 2 rate cuts. But I think that this trade about small caps, about home builders, I think structurally rates are just going to be higher than they were the past 10 years. And I think that's going to take some time to work that through those specific, the home builder sectors, because really the long end is what decides home affordability, not the short end. And we see the long has been coming down. I mean, the way we've been playing it, and it's been fine, it definitely hasn't performed the S&P, is we've been playing RSP, which is the equal weight. And so there you get, diversifications against the mega cap, but you're not taking this huge swing and a miss with small caps, which I think is somewhat of a broken sector, a broken asset class, because it just doesn't look anything like it looked like in the 90s, 2000s, and even 2010s. So that's been our way. RSP's up about 6% year to date, so it's done okay. But I still think if we get a broadening, and RSP could actually do a catch-up trade to the S&P.
Well, I feel like this is another question mark as to whether you'll get a kind of pickup in the RSP if you think that now you're going to rethink rate cuts. I just feel like there's going to be yet another movement back towards the tried and true mega caps. Although if you look, Joe, at retail activity and some of the long onlys, JP Morgan's retail investor radar, they're selling growth within single stocks. So there was some believability, I think, in the cohort of retail that, okay, maybe it's time to sell a little bit here and take advantage of some value elsewhere. The long onlys, according to Citi, on their sector flows, show the exact same thing.
So I think what it does is it pushes out on the calendar. It delays the potential for you to see that broadening out. I don't think it happens in the intermediate term. I actually think, and sitting here myself, thinking about what will be a very fast week in front of us, remember, Jackson Hole is not far away. And I think the risk that you have is that potentially the chairman throws a little bit of cold water on the premise that 25 basis points is guaranteed. So,
well, that's the Leisman perspective.
So I look at
25 or nothing is the new conversation.
So I look at where we are right now, and volatility is pretty low. on a relative basis to where we've been over the last 18 months. Something that you could do is you could go out and you could buy some volatility just as protection against your overall portfolio. I have no problem with that. You're hoping you're wrong. You want to be wrong because you want your portfolio to work for you. But I see that in terms of just how you're thinking about reshaping risk. That's probably makes sense to do ahead of next week.